So welcome back to the podcast, everyone. Great to invite a special guest today who's been on the podcast before. He's had a couple of episodes that have gone down really well. So I thought it'd be really important to invite back Tim Charles, who is an accountant in West London. He's got a chartered accountancy there and been practicing that for over 20 years. So highly experienced, and he's got a lot to tell us today. So Tim, really good to have you back on the show.
Great. Thanks for inviting me. Great to be here.
No, it's great to have you and really appreciate you coming on and giving us your time. I know I wanted to get you on, Tim, because we've been speaking about this together recently, the turmoil that's been going on politically and economically, and it's left a lot of business owners at the moment in a real mess trying to understand what is actually going on. We don't quite know what are the new tax implications and whatever else. We've had a multitude of chancellors over the last few months. So now is probably a really good time for you to come on and give us your expert advice and maybe just clear up for us a little bit of what's happening and what does 2023 potentially hold for construction business owners.
Yeah, that's it, because we had unprecedented in the history of the country 4 chancellors in the space of 4 months. And at one point it felt like they were doing the hokey cokey because we had things in, things out and things out again. So for example, they were going to increase the corporation tax rate to 25%. That was Rishi initially. And then Kwasi Kwarteng and Liz Truss, they came along and said, no, let's go back to 19%. And then Jeremy Hunt comes in after the 4th chancellor and says, no, it's back in again. And the same applied to this higher rate of tax, which you start paying the higher rate and the higher rate tax rate. So we've had things in and out, and some things did go in and out and some things stayed in. So it'd be a good opportunity just to go through what some of these tax changes are. So the new tax year starts in April 2023. So it's only 4 or 5 months away. Yeah,
it's coming around really fast. And I think the problem is even myself, I tried to keep abreast of all this, but if I hadn't have spoken to you, I'd be a little bit clueless as to what some of these changes are. So I think there's going to be plenty listening to this that maybe haven't had that chat with their accountants yet and don't really know what's around the corner in April. So hopefully this podcast will just educate them a little bit as to what to expect. So really appreciate you running through this, Tim. So where should we start?
So shall I share my screen? And I've got a pretty basic spreadsheet. There's nothing too fancy here. But
so if you listen to this on the podcast, we're just going to try and talk you through this spreadsheet as best we can. And if you've got a pen and paper, maybe write some of this down to follow along. We'll also have this uploaded to YouTube. So obviously, if you're watching this on YouTube, you're going to get to see exactly what we're looking at. So yeah, let's go for it, Tim.
Greg, is that sharing okay?
Yeah, I can see that.
Right, great. So the two words beginning of F that I thought we'd start with, and the first word is fiscal drag, and the second word is frozen. And the reason why I want to mention these two words is because the UK government haven't increased the basic rate. Is still 20% income tax and 40% at the high rate. They haven't increased those tax rates, but what they have done, if they've frozen the allowances, so you've got the allowance of 12,570, where the tax-free allowance, and then you got the basic rate band, which is the 50,000, and that is when you start paying the higher rate. And they've frozen that. And they've extended, initially it was frozen until 25, but they've now extended it and they said it's going to be frozen to 27, 28.
Right.
And we were just talking, weren't we, about the UK inflation, and, depending on what report you read, UK inflation, say 11%, there's some reports about it's going to be 14%. So if you can imagine year on year, say you had £50,000 income, quite a few years ago, initially when the high rate tax came in, that the high rate tax was meant to be paid by the rich people. So, say you've got £50,000 worth of income in next year, the year after that, and all these years ahead, you can see what £50,000 is not going to buy you the same shopping basket of goods that 50,000 can buy you today.
Sure. Yeah, that's a significant hit, isn't it? So just to clarify what you mean about the frozen personal allowance. So currently £12,570 is tax-free. You can earn that much without paying any tax. And historically, year on year, they used to raise that by incrementally.
That's it, yeah. So the allowances, so you've got the allowance there of 12,570, and you've got the allowance of 50,270 for when you become a higher rate taxpayer. traditionally all these thresholds used to increase each year in line with inflation.
Yeah, that's it. So by them freezing it and not doing it in line with inflation, it's actually exactly what you said there. If someone's earning £50,000 or £100,000, let's just say 100,000 because it's easier for me to work out. If I'm earning £100,000 and spending £100,000, then I'm actually now going to spend £114,000 potentially with 14% inflation. So
yes, if you want to maintain your same lifestyle and buy the same amount of the same things that you bought the year before, you're going to need to earn that much more to keep up with inflation, just to maintain the same level of standard of living.
Yeah, that makes complete sense. So actually, by them freezing these allowances, it's a little bit of I guess it's another way of doing a bit of a tax increase.
It is massively, because then that's why I've used that word fiscal drag, because you're dragging more and more people into becoming higher rate taxpayers. Because by the time we get to 2028, 50,270, even if you're a construction company with a husband and wife as 50-50 shareholders, and you've got 50,000 each, and you had 100,000 income as a family, if that's what you were living on in 2020, by 2028, that's going to be vastly diminished on what you can get with your 100,000 income.
Yeah, that could be quite significant, especially if, I mean, we don't know what inflation is going to do in the years to come, but yeah, if that inflation compounded year on year, that's going to be awful, isn't it? So that's quite interesting, Tim. So the spreadsheet that I'm looking at here, it shows that the 40% tax threshold is currently £50,000, basically £50,270. Do you find a lot of your clients deliberately try and keep under that threshold? Because I often speak to people and they always say to me, "Oh, I don't want to go above the 40% tax threshold."
Yeah, I think that's quite a good point to bring into the table, actually, because we don't want to. I have had it said to me that, oh, if I earned 60,000, I'd have to pay 40% tax, and in their mind, I think they think that they have to pay 40% tax on all of the 60,000, or on everything above 12,570. They have to pay the 40%. So let's say that you did have a £60,000 income, you still pay no tax up to the 12,000, and you still pay 20% up to the 50,000, and it's only on the extra 10 that you pay the extra 20%, which is the 40% is only on that bit from 50 to 60.
Yeah.
And I'd like to encourage everyone to not have a mindset of restricting themselves and a mindset of thinking, oh, I don't want to pay too much tax. But I guess the point of this of our conversation today is to try and make people aware of what they will be paying. And also the point is as well that because of inflation, you do need to earn more just to maintain the same standard of living. But let's just be aware that we will be paying more in tax. But I think with a mindset of abundance, we want to be trying earning as much as possible.
Yeah, sure. I say that all the time. I mean, just another example. There might be some listeners here that are just starting out as tradespeople, and they might not be VAT registered. And I hear this all the time as well. Oh, I just don't want to hit the VAT limit. I don't want to go over that VAT limit of whatever it is, 83,000. And
85.
85 is it now? Yeah. So what they're really doing is they're just capping their progress in business, because I see it all the time. Once people actually do become VAT registered and they push past that limit, they've released the cap, and all of a sudden it doesn't matter what they earn now. They can really go for it, and they make tremendous progress. So I think it's the same thing with your tax, that limiting mindset, and you're thinking, oh, I don't want to earn over £50,000. I'm going to pay too much tax. You want to be paying, if you're paying a lot of tax, it means you're earning a lot of money, which is a good thing.
Yeah. So it's good to bear in mind that it's only on income over 50,000 that you pay the extra 20% to make it 40%. And just while we're on the subject of VAT, that £85,000 limit has been 85,000 for quite a few years now, and it's also, they've announced that's frozen as well. So more and more tradesmen and all businesses, more and more will be earning over that 85,000 limit. It is good as well to keep track of your income, because sometimes if you're quite small, they don't regularly do their accounts. And I had a client recently that went over the VAT threshold quite a few months ago, didn't know, only sent me his spreadsheets, and then I found out because he's a sole trader, and then he was shocked and he didn't know. So and he said, "Oh, if I'd have known, I'd have done things differently." So just a little heads up there, that if you could keep on top of some basic sets of accounts to at least know how much money you're earning for a 12-month period, then yeah.
Yeah, 100%, because you don't want to get caught out by the VAT man. That's for sure. If you're well over it and not declaring it, so that's important. So you've got just an example here, Tim, about in this spreadsheet about potentially someone earning £100,000, and this could be potentially split into two. So where would this apply? What sort of examples where people could earn £100,000 and have it split? Does that make sense?
No, I didn't get your question. Sorry.
That's all right. So you've got in this example here, you've got someone could earn £100,000 and they potentially might not go over the 40% tax threshold, and that would be because I don't think we touched on this, did we? If there was potentially a husband and wife.
Yeah, sorry. Yeah, so I mean, many construction owners, they're family owned, and they might have the husband and wife as 50-50 shareholders each. So many might set their goal of earning £50,000 each, because another thing to mention here is the child benefit charge. So if when your income goes over 50,000, you start to lose your child benefit if you've got children, and when it gets to 60,000, you've lost it completely. So many couples, they might set a goal if their business is starting to grow a bit, of earning 50,000 each. So you've got 100,000 household income, and then everyone's just paying the 20% tax rate, and you still get the child benefit charge. Yeah. You don't get the child benefit charge, you actually get the child benefit. But obviously, as we've said, if you're capping yourself at 100,000, that 100,000 might not be enough to maintain a family as inflation grows.
Yeah, no, that makes complete sense. Now, it's interesting, actually. I've done a few podcasts and webinars, on this recently, about people setting goals for 2023 and trying to work out what your earnings are. Now, as you know, most people I work with are generally construction companies that might be doing £1 million plus in turnover. So when a business is doing £1 million in turnover, we're generally aiming for about £150,000 in net profit, which is just a nice sort of target to go for business owners. But funny enough, £150,000 is actually the additional tax rate, isn't it? Of not just 40%, but it goes up to 45%. But there's also been some changes in the additional tax rate too, isn't there?
That's it. So it's been 150,000 for quite a long time. Let's not forget that Kwasi Kwarteng and Liz Truss, they abolished the 45% rate, and then Jeremy Hunt came in and put it back in again. So that was in and out very quickly. But then Jeremy Hunt has now gone on to announce, and this was a surprise to me, that he's lowered it from 150,000 to 125, 140.
Wow.
So when if you've got a limited company and you've only got one director and one shareholder, and he's getting £150,000 income, he would now have to pay on the bit from 125 to 150 that he's earning. He'd have to pay 45% on that bracket there.
Yeah.
So if you are in a situation where you're a married couple or have some other family members, then obviously splitting the income between you would have a combined family lower tax rate.
Yeah, that makes complete sense. So that's well worth mentioning, and that I didn't even know that. That was a surprise to me that's been lowered. So that's going to be painful for a lot of high earners there when that comes in, and that starts in April as well, does it?
Yeah, so new tax year, April 2023. This is when all of these things are kicking in that we're talking about.
Yeah.
Just a bit of a caveat. Who knows what's going to happen, because there's another budget statement in March 2023. I would have thought it's too late to change it again, but who knows what's going to happen. But yeah, as things stand, this is what we're looking at.
All right, we might have to have you on for another podcast then, Tim. Depending on how that one goes. Okay. All right, so that makes complete sense, Tim, about the tax thresholds and how the fiscal drag and how people are going to be affected by that. So what does that look like in real terms? If we've got business owners, a lot of them are going to be limited companies if they're running, or they should be limited companies if they're running a sort of £1 million construction businesses. Most people would be taking dividends rather than the salary necessarily. So there's been some changes in dividends, isn't there?
Yeah, that's it. So traditionally, if you're a director, you might take a fairly low director's salary, and you'll take the rest of the balance of the money that you need through dividends, because dividends are the most tax efficient way of taking money from a company. They're a lower tax rate and they don't attract any national insurance contributions. So, this has again been up and down. So with dividends, on top of the 12,570 tax-free personal allowance, you get an additional tax-free allowance for dividends. So that's another 2,000. From April 23, they're halving that to 1,000, and then the following year they're halving it again to 500 quid. And then the tax rate is at the basic rate 7.5%, and at the higher rate 32.5%. They're both going up by 1.25%, so it's going to be 8.75 and 33.75. So say someone's, just to make things easy, if someone's got £100,000 of income, it's going to be around £1,000 extra in tax to pay because of this increase in tax.
Yeah. Okay. So that's not insignificant, is it? So that's another thing we need to bear in mind there with dividends. But still, saying that dividends is still really the way forwards. If you're a big company, dividends is what you should be considering rather than going on PAYE or as a salary.
Yeah, for sure. So just to also clarify, the dividends are distribution of profits. So you need to have the profits there in the first place to be able to distribute them as dividends. Otherwise, you get involved in overdrawn directors' loan accounts, and we don't want to go down that road.
Yeah, that's a really good point. Yeah, so some, we often find is sometimes people take too much on dividends, and then I guess they're it gets a little bit awkward then, doesn't it? So we won't go into that now, but I
guess that's another shout out for doing sort of having regular management accounts and things like that, so that you know how much profits you're making, because a lot of business owners, they've got a good idea of their sales figure, they know what their turnover is, and you might be setting them goals, right? We're going to have £1 million turnover, but what are your profits? So that's why ideally you need to have regular management accounts.
Yeah, 100%. Yeah, without a doubt, that's so important. Okay, so dividends make sense. Anything else on that, or is that dividends wrapped up?
Yeah, I think yes, a small increase there, and but that, as we said, it remains the best tax efficient way of taking money out of a company.
Yeah,
it'd be good to now go on to, for the company owners, the corporation tax rates.
Yeah, so this is maybe one of the more complex things that I haven't really got my head around until you went through this with me. So yeah, let's talk about that. So we know what it's been historically. It's always been, well, it's been for a long time, 19% corporation tax, isn't it, on profits? So
that's it, and it's been 19% as well for everyone across the board for quite a long time. So you've got your big multinational companies, they're paying 19%, and a small startup construction firm with tiny amounts of profits, they're also paying 19%. It's been flat across the board for everyone.
Yeah, that's it. Okay, so now there's a change based on profits, isn't there? So what have they introduced?
Yeah, so this is starting from April 23. So profits up to 50,000 are taxed at 19%, and then between 50 and 250, you have what they call a marginal rate, and then over £250,000 in profits, you're paying 25%.
Yeah. Okay.
So just to make that, here's an example we just quickly knocked out. Say you had a limited company which had £150,000 in profits. At the moment, they would pay just a flat rate of 19%, which would be 28,500. But under the new system, you pay 50,000 at 19%, and then 100,000 for your 150,000. You've got a marginal rate, which is 26.5%. So you would pay £36,000 in corporation tax, whereas before you're paying 28,500. So we're looking at, in that scenario, £7,500 increase in corporation tax.
Yeah, wow, that's let me just to understand that marginal rate, because we've got here that it only goes up to 25%, but you've got 26.5% as a marginal rate. So does it go over that amount? Does it? over the 20? It can go over 25.
What it is it's just basically it's a way of working it out. So if you on your income over 25 over 250,000, you pay 25%.
Yeah.
And then under 15%, you pay 19%. But as a way to work it out, the calculation, you need to have a marginal rate for this is so that 26.5%. I'm not putting that on the whole 150,000.
Just on the 100.
Yeah,
okay.
It's just on the 100 because that bit there. So between 50 and 250, you've got this increased amount, and that's just a marginal rate just for that margin. From 50 to 250.
Okay, right.
Like I said, that it was much easier to work all this out when everything was at 19%.
Yeah.
So as a marginal rate, it's 26.5%.
Yeah, but the long and short of it is, without getting too bogged down into the numbers, a business that has £150,000 profit. Now, this will capture a load of my clients and others listening to this that are running £1 million plus businesses. If they're earning £150,000 in profits, they are going to be £7,500 worse off with these corporation tax rises. Is that right?
That's it. Yeah, and I guess we've got to add this up with, you've got the corporation tax rises. We discussed the dividend tax rises and the fiscal drag in terms of paying more tax at the higher rate. So when you put everything together, it's compounded to was paying significantly more tax.
Yeah, that is
next year.
That's very big actually. Yeah, that's quite a lot when you look over the whole lot. Okay, that's really interesting. So how would someone find out? Because the bit I still don't get fully is this marginal rate bit. So how would someone find out what that is? They just need to talk to their accountant to work out, if they're sitting somewhere in between 50 and 250,000.
Yeah,
how would
so
they be able to work that out?
If you could just this figure here, 50,000, that's fixed and 19%. But if this figure here, say you had £200,000 of profits in your limited company, you would then do 150,000 at 26.5%.
Oh, so it's always at 26.5%.
And when your profits are
over 50,000. Yeah. Okay. Yeah, I get that. All right. So that's straightforward then. So that's useful to know. Okay, so there's something really significant there with corporation tax, and I know what I've been doing with my companies and my accounts is we always, at the end of our profit and loss balance sheet, we always put a 19% figure in there, corporation tax, just so we know how much we put in and save. And I know a lot of businesses don't do that, but we've always found that really useful just to add that in each month. And then that sits on the balance sheet telling me how much I've got to have saved for corporation tax. But now I guess it gets a little bit more complicated to do that each month.
Yeah, it's going to be 10 times more complicated because what you're doing there is excellent, because there's no point coming to the end of the year and having a big surprise tax bill. So if we work on zero, and you can just put through a journal to estimate what your corporation tax bill is going to be each month and have it at the bottom of your P&L and every month, and then you can prepare for it. But yeah, I agree, it's going to be significantly more complicated to work out what that looks like. Yeah.
So I guess either people need to be just going on the safe side and putting 26.5% away, or somewhere in between 19 and 26.5. They'll just have to talk to their accountant and work out what that figure should be on average based on previous years potentially, just to make sure you're putting.
So I probably should have mentioned this a minute ago, but there's an effective rate of 22.75%, so you can use that instead just to work out.
Okay, oh, that's good to know. Yeah, so if they use 22.75% each month off of their profits, so if they made £10,000 profit at the end of December, deduct 22.75% off of that, and that's the retained earnings.
Yeah, if you think that your profits are going to be over 50,000, and hopefully they are, then you can use this, what we call an effective rate. So just to clarify, the effective rate we need to apply on the whole lot of 150,000. I use the marginal rate to try and emphasize the point that of you've got 50,000 at 19%. And then anything above 50,000, you pay at the marginal rate. But you could just use this effective rate and apply that to the whole lot if you want to do your journal in Xero or QuickBooks, whatever you're using.
Yeah, that makes sense. Yeah. So we probably, anyone that's not looking at this spreadsheet is probably really confused now if you're just listening to it on the podcast. So you're gonna have to tune into the YouTube channel and watch this. That all makes sense to me, Tim. Okay. So
right, now,
go on. What's the next
I was
section?
going to say, now someone could have the bright idea of, why didn't I just open 10 different companies, spread my money over 10 different companies, and earn £50,000 in each one, and then I don't have to pay any higher rate.
So you're reading
or anything more than 19%.
You're reading my mind.
Right. So I want to introduce you to a word that you might not have come across or discussed, but associated companies. So associated companies, let's not get, it's basically a company that has common owners and directors. So say you've got, let's go back to our husband and wife traditional setup. Let's say they had their construction company, but they also had a window cleaning company. So two completely different brands. They've got two completely different names. But let's say that over the years, the window cleaning company, they didn't have enough time to invest in building it up, and it was just ticking over. And they had their main construction companies got £100,000 in profits, and their window cleaning company is just ticking over, and it makes a couple of grand in profits, and they don't spend any time dealing with it. As things stand now, they'd have the flat rate of 19%. But to stop, I guess this is like an anti-avoidance measure, to stop people doing this and spreading the 50,000 across numerous companies. Now, if you've got an associated company, so common owners, you would have to split that 50K across two. So now £25,000 would be given to company one, and £25,000 would give to company two. So for that 19% band, you could see for this small company that they haven't really been spending a lot of time with, but it hasn't been causing any issues. They're wasting £23,000 at the 19%, and company one is suffering by paying the marginal rate so much quicker.
Yeah, so basically you get your allowance reduced. If you've got a second company, your £50,000 allowance is now reduced to £25,000 if you've got two companies.
Yeah. And if you had four companies, it would be split four ways, and five companies, it's split five. So if you had five limited companies, you would have £10,000 allocated to each one.
Yeah. That's really
not for the 19% ban. So so in this scenario, we see that this company too, the window cleaning company, is wasting so much at the 19% band. So what I would recommend in this scenario is they look at deciding what they're going to do with this window cleaning company, and they need to make some decisions. So they might say, well, we're not bothered about the window cleaning business. It might be a good opportunity to sell it. You could sell the goodwill, make a bit of money there. Another option is to turn the second limited company, maybe you could turn it into an LLP partnership. Or what you could just do is fold in the second limited company, the window cleaning one, fold it into company number one. So you could still have a trading name. So if you're called ABC Limited and this was the window cleaning company, you could still trade as the window cleaning company, but just it's all taxed under the ABC Limited.
Yeah, and I think that's a really good idea. I know, I've been guilty of this myself over the years, coming up with companies and doing it for a bit and then not focusing on it because something else was much more successful. And we hear this all the time where people, they want to branch off. Maybe an electrician then wants to get into solar, so he's got a little solar company, and that's a completely separate brand. But actually, having a trading as name can be really beneficial, can't it? Because you've only ever got one set of accounts. You're only paying, the accountant once to do that. But I think what's also really good now is when you're using software like Xero, it's actually quite easy to have separate branding, and you can actually itemize it out quite easily in there, can't you? The different trading companies.
Yeah. So in Xero, you've got different invoice settings. So you could have so you can still send out the invoices from your ABC Limited, but the invoices can be branded completely different. And you can use things like tracking categories so that when you've got your profit and loss account, you can still see what is the profit and loss for your main company and what is your profit and loss for the other company that you're tracking, so that you can still see things differently between, in this scenario, the construction business and the window cleaning business.
Yeah.
But you could just keep it in terms of reporting to Companies House, and in terms of not wasting your 50,000 19% brand band, you'll be making things easier and not wasting any tax potential.
Yeah, because that is actually, the more you think about that, especially if you've got multiple companies, that is really significant. And just to clarify, what you've said is that it's an associated company by the directors or the owners, rather than it being the same, like related. Like, it doesn't have to be two construction companies, could it? It could be a construction company and an accountancy firm like you've got.
Exactly, yeah. Just it's regardless of what they're doing, it's whoever owns it. That's the test for the associated companies.
Wow. Yeah. Okay. So that's that's really, sorry, my brain's just ticking over now, thinking about all the people this is going to affect with. I don't know how that affects people with property. We've got buy-to-let companies and all sorts. There's quite a lot involved in that, isn't there? But
I think, have a chat with your accountant on that.
That's that goes.
One thing I just also wanted to point out is that if you had a dormant company, then a dormant company, it wouldn't be affected. So if you had company one and company two was dormant, then company one would still get all its 50,000 at 19%. But I just wanted to emphasize something for dormant companies, because I've got lots of clients that think, in their mind, they think that company number two is dormant. But when I actually get the bank statements for company number two, for this so-called dormant company, I can see transactions going through. And if there's transactions going through, it's not a dormant company.
Right.
So make sure that that you have the chat with your accountant to make sure that any extra companies you've got, make sure they are genuinely dormant. Otherwise, in your mind, you might think, oh yeah, I'm not doing anything that is dormant. But the accountant, he might not even had the conversation with you because it wasn't worth having the conversation. But it's not been filed as dormant accounts. You need to, we've got until April 23. It's not long, but we still got 4 or 5 months to tidy this up. That
isn't long at all. So 100%, people need to think about getting their affairs in order if they've got multiple companies, and that is going to affect so many people, because I just know I'm just thinking of all the different people I've worked with and I've spoken to, the amount of people that have more than one limited business. It's that's really significant. So thanks for bringing that up. This is the first time I've heard of this, Tim. So is this and we're talking April now that this is coming into play. So is this common knowledge amongst everyone? Because it's that's
funny enough. I was at an accountancy conference last week, and I brought it up, and not a lot of accountants were on the ball with this. And I think it's going to be a much bigger thing than many accountants are thinking, because as you just said, so many of my clients have multiple limited companies, and sometimes they even open limited companies without telling me, because it's just an idea they have. So I brought it up as a topic to discuss with a tax technician who was giving the talk, and they ran through this example with me. But many accountants in the room, they hadn't really switched on to this. So I think it's great that we're highlighting it here.
It really is, really, really important. So if you're listening to this and you've got multiple limited companies, have an urgent chat with your accountant and just bring this to his attention about these associated companies, because you don't want to come unstuck from April onwards. Thanks for that, Tim. That's useful. So let's talk about something positive.
Yes, I feel like we've gone through a lot of doom and gloom so far in our conversation. So let's at least finish on a positive. So we've got something called super deduction. Actually, we've only got 3.5 months left of this, as we are here in December at the moment. So from the 1st of April 21 to the 31st of March 2023, super deduction was introduced. So this is to try and encourage investment. So it only applies to new assets that you're buying. So for example, if you buy a new van, a new computer, or any new equipment, new tools, new machinery, you can uplift whatever you buy by 130%. So I thought I'd run through a couple of examples with you. So if you want to buy a new van, you walk into the showroom and it's £24,000. Obviously, you can reclaim the VAT of 4,000, so that actually cost you 20,000 net. With super deduction, we uplift that by 130%, so that takes it to 26,000, and that 26,000 is used to reduce your corporation tax bill. So as things stand, we're still working on the 19% in this example, but your corporation tax is 19%, so that's 4,940. So the cost to you of that £24,000 van is 15,060.
Yeah, that's massive, isn't it? So if you're thinking about getting a new van or some new plant or whatever it's going to be, and there is a significant investment to make, that investment needs to be made before the 31st of March, doesn't it, to benefit from this?
To get the super deduction, yeah.
And have they said that that's going to be removed from the next tax year? Have they not mentioned?
As far as I know, that's when it finishes.
Yeah. Okay.
Yeah.
Right. So we'll watch this space on that one. That might go. So,
and I thought it'd be good for go for another example. I mean, me and you are big iPhone fans, and you know, this applies to iPads and all computers. But having a really good iPad and iPhone, I think they're great for boosting productivity and helping you work faster and smarter. So I thought I'd go for an example. I mean, if someone just rocks up to the Apple shop, then let's say you had to pay $1,200 for an iPhone, and that person had to pay that £1,200 out of their taxed income. Whereas if you've got your own limited company, you pay $1,200 on your next VAT return, you reclaim the $200, so that cost you $1,000. Then we're going to uplift it by 130% for the super deduction. So then the corporation tax deduction that reduces your corporation tax is 247. So that 1,200 iPhone actually cost you 753. Yeah. And if that's also boosting your productivity and you're helping you work smarter and faster, then that I think that represents a good investment for business owners to make.
I think so. And you've just given me an excuse now, Tim, to go and get a new iPhone. I've got to keep up with the latest model. I don't know what model we're on now. What is it, 14? Not sure. But yeah, that's a good example. So yeah, that's really useful, and that is positive because there's a significant tax deduction you can get there, and you want to make the most of that if you're looking at investing. Now, just a bit of a caveat to that, Tim. Again, we hear sometimes people are getting the wrong advice from accountants where they're saying, look, let's get your tax bill down. Let's go out and spend some money and get a van or get this and get that just so you can benefit from that. But what's your thoughts on that? Buying things just to get tax bills down. Is that the right way to do it?
There's an expression that I've always loved, and that's the dog must always wag the tail, right? And you must never let the tail wag the dog. And your tax is that tail, and you are the business. So you always must make a business decision first. There's no point just doing things for the sake of tax, because tax is only a small element. It's only the tail. Yeah. Tax rate is 19%, or we've got a little bit of we've got increases there, but the tax is only a percentage. The business must, first of all, what is a good business decision to make? Do I need a new van? Is the van going to help us increase our productivity? Is it going to help us work faster and better? Is it going to be a good impression for customers? So you must always think about return on investment. If you spend £24,000 on a van, I know you can reclaim the VAT and the super deduction, but it's still £15,000 that the company's it's going to cost the company. There's got to be a return on investment on that. Same with the iPhone and all these things. So there's no point just doing things for the sake of reducing your tax bills. First of all, got to be a great business decision.
Yeah, I think that's really important to say that, because again, it's sometimes a false belief that a lot have, that they just get some wrong advice from accountants. So I think that's really sound advice there, Tim. So that's really useful. I really appreciate you running through that. Is there anything else you need to go through on this screen, or are you pretty much?
No, I don't want to bring any more doom and gloom to your listeners.
No, that was brilliant. That was great. What I might do, Tim, is just to make it easy for my listeners, on the YouTube channel, I might just put a link to that spreadsheet that you had there. So maybe you could just send me that after, and we'll put that in the link notes. And
yeah, sure.
You also offered kindly, I know you're in my Facebook group, aren't you, Tim? It's the just if anyone's not joined that on Facebook, it's called the Construction Trades Accelerator. So search for that, and you'll be able to get into that group. Lots of free videos and advice and tips on how to run and grow your business. But you're also a member of that group, Tim, and you kindly jump in there and help out now and again with any tax tips. You sort of made a little offer before you come on the podcast to.
Yeah, so if anyone's got any questions on and we brought up a whole bunch of different topics here, some of them a bit technical, but generally speaking, if anyone's got any questions, put them in the Facebook group, and then if you tag me or and then I'll try my best to answer any questions in that Facebook group. And that could be a good way of, because no doubt the questions you've got are the same questions that other members of your Facebook group have got, so it'd be helping everyone to answer those questions.
Yeah, it really will. So yeah, really appreciate that, Tim, and thanks for offering so much value. Just to let you know, your podcasts are one of the highest listened to, your previous ones on my
fantastic
show.
That's good to know.
Yeah, that's it. So which is great. You're up with some good company there. So I hope this one is of value. I know it will be, because it might go over our heads a little bit. So it might be one of those ones that you just want to maybe listen to again, get that spreadsheet in front of you and really try and get it right in your minds. And if you don't get it, have a chat with your accountant, but at least you're a little bit more aware of what's happening. And as we say, these changes are coming around fast. April is going to be before you know it.
Yeah, just 3 months away, isn't it?
That's right. Yeah. So thanks a lot, Tim. Appreciate your time, and we'll catch up soon.
Thanks, Greg. Cheers. Thanks for having me on.